I think it will be a very bright 4 years for people who hold gold and silver because inflation is here. It's not going away. It's only going to get worse. And Trump's policies of a weak dollar, of low interest rates, that's a massive loss of purchasing power, is very gold friendly. I think gold will be pegged to a new monetary system. I do. And Bitcoin will have its role. But you cannot have something that is that volatile pegged to a monetary system. It doesn't work. You cannot, it has to be stable. And that's what gold represents, is more stability. And it's not only owned by all the central banks, but reclassified as the world's only other tier one asset by the BIS. Why didn't they choose Bitcoin? Why didn't they choose special drawing rights?
In a significant shift within the global financial landscape, central banks increasingly turn to precious metals as a cornerstone of their reserve diversification strategy. AndySchectman, CEO of Miles Franklin, has been particularly vocal about this trend, noting that central banks consistently acquire substantial quantities of gold and silver monthly, favoring these tangible assets over digital alternatives like cryptocurrencies. This strategic pivot has gained momentum, as evidenced by discussions at the London Bullion Market Association's conference, where central bank representatives emphasized their commitment to diversifying reserves. The strategy proved remarkably prescient during the high interest rate environment of 2022 and 2023, helping to maintain gold's stability. However, this year's dramatic 28% increase in spot gold prices has prompted some institutions, including China's central bank, to pause their acquisition programs temporarily. Russia's central bank's inaugural move into silver markets is a notable development in this trend. As a significant silver producer, Russia's entry into silver investment coincides with projections from the Silver Institute indicating a substantial supply shortfall of 663 million ounces between 2022 and 2024, driven primarily by increasing industrial demand. This strategic diversification reflects a broader understanding of silver's growing importance in the global economy. The relationship between precious metals and monetary policy has become increasingly relevant, particularly in light of potential policy shifts. Schectman points to the possibility of Trump-era policies returning, characterized by a weaker dollar and lower interest rates, which could significantly impact purchasing power. Historically, such conditions have proven favorable for gold investments. The fundamental dynamics of the precious metals market continue to support their appeal as a store of value. Gold's limited annual production rate of 1 to 2% provides a natural hedge against inflation, while lower interest rates typically weaken the dollar's appeal to international investors. This combination of factors reinforces the enduring attraction of precious metals to both central banks and private investors, particularly during periods of economic uncertainty. Before watching this video, subscribe to our channel, hit the bell icon to never miss an update, and share it with others.
Right now, I mean, they have a common settlement system. It's gold. And as James Rickards said the other day, if he was Powell, he would just front run the BRICS nations and buy gold massively. And maybe they will. But I don't think this is any to be worried about if you own. I think it will be a very bright 4 years for people who hold gold and silver because inflation is here. It's not going away. It's only going to get worse. And Trump's policies of a weak dollar, of low interest rates, that's a massive loss of purchasing power, is very gold friendly. And not to mention, quietly, you have, like I said, Scott Bessent, the Treasury Secretary, who his largest holding is gold. He understands it. And maybe we get Judy Shelton in to have her hopefully coming on my show real soon, and you will be coming on my show too. I've asked my staff to reach out to him. Surprised they haven't. If they haven't, but you're on the short list. But I'm going to get Judy on too. And Judy, I just bought her book, and she advocates. She's the closest thing to a gold standard advocate as you'll ever find, and advocates for selling treasuries, which are losing desirability globally, and have them collared to gold and redeemable in gold at maturity. So even though we don't hear much about gold, all we seem to hear is crypto. I find it interesting, and from a contrarian standpoint, that the central banks aren't buying crypto. The central banks continue, and massively, month over month, the numbers keep going up, are buying silver and gold. They're buying, you look at Bill Gates, what's he buying? They notice Bitcoin, and maybe they own some personally, but they're buying commodities and tangibles, and that's not stopping with the election favoring Trump. Their central bank would not have reclassified gold as the only other tier one reserve asset for a reason. They don't do things for shits and giggles. They do it because I think they see something in store for gold. I think gold will be pegged to a new monetary system. I do. And Bitcoin will have its role. But you cannot have something that is that volatile pegged to a monetary system. It doesn't work. You cannot, it has to be stable. And that's what gold represents, is more stability. And it's not only owned by all the central banks, but reclassified as the world's only other tier one asset by the BIS. Why didn't they choose Bitcoin? Why didn't they choose special drawing rights? Why didn't they choose something else and choose gold? And I think we shouldn't lose sight of that, along with the massive acquisition and draining of the world's exchanges by the central banks. So, moral of the story, I'm not a Bitcoin basher. Bitcoin probably has a good run in front of it, and maybe a sustained one, maybe much higher than I can even dream.
AndySchectman provides insight into the precious metals market's recent performance, highlighting its transition from overbought to oversold conditions before finding equilibrium. The market's resilience is evidenced by gold's swift recovery of over $100 from its recent dip, while silver has demonstrated stability by returning to previous trading levels. As markets move into the weekend, gold continues demonstrating its fundamental strength, recovering from a 2-week low while maintaining levels below $2,650. The benchmark influences market dynamics' 10-year U.S. Treasury bond yield, which remains subdued below 4.2% in negative territory following the release of recent U.S. labor market data. According to FX Street data, the silver market has exhibited particularly noteworthy stability, with current trading at $31.34 per troy ounce. The precious metals performance through 2024 has been impressive, registering a substantial 31.70% increase since the beginning of the year. This significant appreciation underscores silver's strong market position despite periodic fluctuations in daily trading. Perhaps most telling is the emergence of a clear trading pattern, particularly in the gold market, where prices have consistently returned to the $2,645 per ounce level. This recurring price point has become a gravitational center for trading activity, suggesting the market has entered a consolidation phase as participants position themselves for 2025. Let's get back to the video.
You look at the commercial banks, and the Western commercial banks have been suppressing gold and silver for a very long time. And in silver on COMEX, they're short between 7 and 800 million ounces. That's a whole year's worth of production. In London, which is far more opaque, less transparent, over-the-counter market, meaning it's just me dealing with you, not an exchange where there's rules and regulations, they're short between 4 and 6 billion ounces. So every dollar run-up was costing these banks between 4 and 6 billion in London, and between 7 and 800 million in the United States, and huge short positions in gold too. And so they used this euphoric development as the ability to kind of try and reduce their short positions and kind of balance off their or help normalize their balance sheets. They're still a long way from it. But when that happened, just the first commitment of traders report that came out about, so would have been about 2 weeks ago, showed that they had reduced the commercials, their short position in gold, by 15,570 contracts. Whatever, 20475000000. That's how many ounces, or the value at 2,600. I think that's right, 20,475,000,000. That's how much they reduced their short position. And in silver, 5,700 contracts were covered. 5,700 times 5,000 is 2,800,000, or that's 28,500,000. Is that right? 28 million, I think that is right. Yeah, 28 million, not as much. So 28,500,000 they covered right away. They still are short over 33,000 contracts. They're still short 198,126 contracts in gold. I mean, think about that. These are commercial banks that have massive existential threats to their existence. Short contracts that, as the price keeps going up, is putting greater and greater and greater and greater strain. As people were selling gold, going to crypto, going to whatever they were doing in anticipation of this new Trump trade. And the exuberance that went along with it, it was a perfect time for them to cover their shorts and maybe even push the ball down the hill by shorting it, dropping it $20 or $30, and bang, 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 and triggers more and more sells. And all of a sudden you get gold fall off by $200. And what do? They cover 15,570 contracts at 100 ounces a piece. And you know what? I think I might have multiplied it by 500. That's why I was wrong. Let me do that again.
Sure.
Times 100, that's more like it. So that's 15 million no, 1,575,000 ounces times 2,600. What's that? 4,950,000,000. So that's a little bit more like it. So, anyways, the bottom line here is that they use that environment to normalize their balance sheet best they could to knock weak hands out of the market, to cover their old stale short positions that were beating them up. And to me, plus it was massively overbought. Now it's massively oversold, and gold's come back well over $100. It's still about $75 from its peak, and silver is really close to where it was when it all fell off.
Gold and silver remain resilient amid market volatility, driven by central bank diversification and commercial banks adjusting short positions. Gold continues to hedge against inflation, while silver's stable performance and rising industrial demand reinforce its value. Both metals are poised to retain appeal, reflecting broader economic shifts and investor sentiment. What do you think? Will gold and silver continue to rise, or is there more volatility ahead? Drop your thoughts in the comments below. If you found this insightful, don't forget to like, share, and subscribe for more. Thanks for watching.